Welcome to Aither Insights. This is the show where we take complex market analysis, looking at crucial regulations and topics in the environmental commodities markets, and we really try to break them down for you.
That's right.
So if you're a project developer, maybe a corporate sustainability manager, or perhaps just someone who's really curious about how we build a more sustainable future, then you're definitely in the right place.
Absolutely. Here on Aither Insights, our goal, really, is to pull out the most important bits of knowledge and insight. We want to give you a shortcut to being truly well-informed. We'll share some surprising facts. We want you to feel confident navigating these, let's face it, pretty intricate and vital markets.
Couldn't agree more. So today we're doing one of our Aither Insights explorations into a really critical strategic shift that's happening right now in the voluntary carbon market.
Okay.
The topic is why companies are signing multi-year offtake agreements.
Yes. Very topical.
It really is because, with the supply of genuinely high-quality carbon credits getting tighter and tighter, we're seeing savvy buyers turning to these long-term purchase agreements.
Makes sense.
And it's not just about securing future access, though that's a big part of it. It's also, crucially, about hedging against rising prices and, really importantly, ensuring the integrity of their climate commitments.
Exactly.
So this discussion is all about understanding the implications, the ripple effects for market dynamics and for project financing, and also why these long-term structures are proving so beneficial, really, for everyone involved.
Precisely. Our mission today is to clarify why these multi-year agreements are gaining so much momentum right now, and importantly, what that actually means for both the project developers out there looking to sell credits and for the companies seeking to offset their emissions reliably and, reputably. So yeah, let's explore this landscape.
So let's start with the basics then. We hear these terms thrown around a lot: offtake agreements and forward purchasing in the carbon market. Can you kind of unpack those for us? What exactly are they? And importantly, how do they differ in practice? Because they sound quite similar, but I know there's a key difference.
That's the perfect place to start, absolutely.
Yeah.
Because understanding these terms is, well, it's foundational to grasping this whole market shift.
Right.
Okay, let's begin with an offtake agreement. Think of this as essentially a legally binding contract. And in this contract, a buyer commits to purchase, or sometimes they just get the right to purchase, a specific quantity of carbon credits. And this happens at a predetermined future date. Now, the really crucial distinction here is that the payment for these credits is not made upfront. The credits themselves, they get issued at some point down the line, usually when the project has actually achieved and verified its emission reductions or removals. And the prices, well, they can be fixed, which offers certainty for both sides, or they could be variable, perhaps tied to market indices. It really depends on what the parties negotiate and agree upon. But the core purpose of an offtake agreement is sort of twofold. For the project producers, the developers, it provides a guaranteed market. A buyer is lined up. And that means stable revenue streams down the road.
Which must be huge for financing.
Exactly. Think of it as a strong signal to lenders and investors. Look, there's a buyer waiting for our product. This significantly helps their financial planning, and it really de-risks the project in the eyes of finance providers.
I see.
And then for the buyers, in turn, it helps them secure a reliable future supply. They know they'll need these credits to meet their long-term sustainability goals, their net zero targets.
Right.
So it's about locking in that future volume, but without tying up their capital immediately.
Okay, that makes sense. What about forward purchasing then? How does that differ?
Right. So forward purchasing, it also involves an agreement to buy future credits, so that part's similar. But the critical difference, the absolute key, is that payment is made now, upfront. Big difference. These credits are typically from projects that are still under development. Sometimes they're even in the very early conceptual stages, or maybe they just haven't quite started operations yet.
Right, so much earlier stage.
Much earlier.
Yeah.
And the primary benefit of this approach for the project developer is that crucial upfront funding it provides.
The cash flow.
Exactly. This capital is absolutely vital for them to scale their operations, maybe accelerate the project development timeline, and ultimately meet their carbon credit delivery goals down the road. Honestly, without this kind of early cash infusion, many innovative, high-impact projects, they simply wouldn't get off the ground. It bridges that early funding gap.
That's a really important point.
It is. Now, for the buyer, why would they pay up front? Well, forward purchasing often offers significant price advantages. They might get a discount for providing that early capital, and it gives them greater certainty on price, effectively acting as a powerful hedge against future price volatility and potential supply shortages in the market.
Like locking in a price now for something you get later.
Precisely. It's a bit like buying futures in traditional commodities, but you're doing it for carbon credits. It's worth noting, a report back in 2023 highlighted this. They saw an enormous jump in forward purchases of removal credits. So it underscores that while these structures offer tremendous opportunities for both sides, funding crucial projects on one hand, securing supply on the other, they also come with inherent risks, especially for the buyer paying up front. Risks that demand really careful management.
Okay, that distinction makes perfect sense. And you touched on financing there, which sounds huge for developers. So looking at these agreements, maybe focusing a bit more on offtakes for a moment, what are the primary advantages for both the developers bringing these climate solutions to life and the corporate buyers needing credits for their strategies? It sounds like there's a powerful mutual benefit here.
You're absolutely right. There's a strong, almost synergistic mutual benefit. That's really what drives the adoption of these structures. Let's look at project developers first. For them, these agreements, especially offtake agreements, are truly game changers, particularly when it comes to project financing.
Right, you mentioned bankability.
Exactly. In many, many cases, having a signed offtake agreement is basically a non-negotiable precondition for getting loan approval from banks or other financial institutions.
Really? A precondition?
Often, yes, because this is what makes a project bankable. Lenders need solid, documentary evidence that supports the project's projected cash flow forecasts. And a signed offtake agreement provides exactly that certainty. It proves that a guaranteed market exists for the project's output, the tons of CO2 removed or avoided.
So it proves someone will buy it.
Precisely. And this translates directly into guaranteed income and predictable profits, often for many years into the future, which, as you can imagine, significantly reduces the financial risk for lenders.
Yeah, I could see that.
And that encourages much-needed investment into vital climate action projects that might otherwise be seen as too risky. It can literally be the difference between a promising idea staying on paper and it becoming a fully funded operational project, making a real impact.
That's huge. Okay, so that's the developer side. What about the buyers? What are the main draws for them?
Right. For buyers, the benefits are equally substantial, and they directly address some of the biggest challenges they face in the voluntary carbon market today. First off, these agreements are crucial for securing access to credits.
Getting all of them.
Exactly. We're in a market where demand for high-quality, verifiable credits is rapidly going up. Projections show it's likely going to outstrip supply.
Which means prices go up.
Inevitably, yes,
Yeah.
leading to rising costs. So these agreements ensure reliable access to the specific types of credits a company needs, often at reasonable, pre-negotiated prices.
So they avoid the scramble later.
Precisely. Without these agreements, buyers risk being less scrambling for credits on the spot market later on, potentially paying exorbitant prices, or worse, having to compromise on the quality of the credits they buy.
Okay, so access is number one.
What else? Second, they greatly assist companies in their long-term planning, for their net zero journeys. By locking in future volumes, and sometimes prices too, companies get a much more definite, predictable picture of their future offsetting costs and the carbon volumes they can actually count on.
Budget certainty.
Exactly. That predictability is invaluable for strategic environmental planning, for budgeting, for reporting to stakeholders. It provides a much clearer roadmap towards their climate commitments.
Makes sense. Any other key benefits?
Yes. A third one, and this is often overlooked, I think, is that these agreements tend to foster much deeper, more innovative partnerships. Well, unlike simple one-off spot market purchases, which are purely transactional buy-sell, done these multi-year commitments inherently build genuine relationships between the buyer and the project developer.
Right, you're tied together for longer.
Exactly. And these relationships can drive more impactful, more tailored climate solutions. It might allow for co-creation of projects that meet specific corporate values or perhaps address unique supply chain emissions for that buyer.
Interesting, like customizing a project.
Potentially, yes.
Yeah.
Imagine a buyer being able to have some influence on the design or even the location of a project to better align with their own operational footprint or community engagement goals. That's powerful.
Yeah, definitely beyond just buying a credit off the shelf.
For sure. And finally, there are often considerable price advantages. As we touched on with forward purchasing, buyers can often lock in prices, frequently getting a discount as they're providing upfront capital.
Right.
Or even with offtakes where payment is later, they can at least hedge against significant future price increases. This protects them against the financial shock of market shortages and helps ensure their long-term offsetting strategy remains cost-effective and resilient in what's likely to remain a pretty volatile market.
Okay, that lays out the benefits very clearly. It really does feel like the market is undergoing a significant transformation. What are the key market dynamics, the bigger picture forces that are driving this critical shift towards these multi-year strategies, particularly off-takes right now? It feels like it's more than just simple supply and demand, isn't it?
You're absolutely right. It's much more nuanced than that. We are indeed in a truly significant transition phase in the voluntary carbon market, the VCM. And the defining feature of this phase is an increasingly strong and I'd say urgent focus on quality and integrity.
Quality being the key word.
Absolutely. The Ecosystem Marketplace's 2025 report provides some crucial insights here. It paints a clear picture of this evolution. Interestingly, while overall transaction volumes did see a fall, about 25% in 2024.
Okay, volume's down.
Yes. Credit prices only saw a modest decline, around 5.5%. And perhaps most remarkably, credit retirements, that's credits actually used to offset emissions, held steady at 182 million tons.
So volume's down, prices mostly stable, retirement steady. What does that tell you?
It tells us there's still resilient underlying demand for carbon credits. Companies are still committed to using them. But, and this is the key, they're becoming far more discerning about which credits they buy.
Ah, the flight to quality we hear about.
Exactly that. The market is undergoing what some are calling a supply-side reboot. It involves a deliberate winding down, or at least a discounting, of projects based on older, less rigorous methodologies that have faced, frankly, quite a bit of scrutiny over issues like additionality or permanence.
Right, the older stuff is less trusted.
Generally, yes. And at the same time, there's a concerted effort to scale up new, higher integrity projects based on updated methodologies and better verification. But this transition creates a temporary yet significant shortage of these high integrity credits. One expert points this out. He says, this shortage is a key reason for the lower overall trading volumes we saw. People want the good stuff, and there isn't enough of it readily available on the spot market right now.
So that shortage drives the need to lock in future supply?
Precisely. That critical shortage is exactly what makes securing future supply through these long-term agreements absolutely paramount for discerning buyers. It's a fundamental shift from, any credit will do to only the best, most verifiable credit will do.
Got it. Are there data points that back this up?
Oh, definitely. Let me share a couple of really fascinating data points from 2024 that truly underscore these shifts and the increasing value being placed on quality and specific credit types. First, credits representing emissions removals, think direct air capture or reforestation, were 381% more expensive on average than emissions reduction credits, like renewable energy or cook stove projects.
Wow, 381%. That's huge compared to what it was before.
It's a dramatic jump. It was 245% the previous year in 2023. So it shows a clearly accelerating market preference for removal-based solutions over avoidance or reduction-based ones.
And why is that, do you think?
Well, removals are often perceived as offering greater permanence, a more direct, tangible impact on atmospheric CO2 concentrations. It's seen by many as a more direct counteraction to emissions.
Okay, that makes sense. What was the other data point?
The other striking finding was that buyers showed an unprecedented preference for recent vintages.
Meaning newer credits.
Exactly. Credits issued within the last 5 years. Buyers paid a staggering 217% premium for these recent vintages compared to older ones.
217%. That's also massive. What was it before?
It was only a 53% premium in 2023.
So a huge jump there, too. What does that signal?
It's a very clear signal of strong demand for fresh, high-quality projects. Projects that align with the most current standards, the latest methodologies, and maybe have more robust monitoring data available. It reflects a desire for immediate, tangible, and highly verifiable impact. Buyers want assurance that credit is solid now.
Okay, so premium for removals, premium for recent vintages.
Exactly. And you couple these trends with the work being done by the Integrity Council for the Voluntary Carbon Market, the ICVCM. So putting it all together, securing verifiable quality supply through long-term agreements, it's just no longer just a sensible option. It's rapidly becoming a strategic necessity for any company that's serious about its climate commitments and, frankly, about managing its public reputation.
It sounds like the risk calculation has changed.
Completely. Companies are realizing that the reputational risk and potentially even the financial risk from being associated with low-quality, maybe non-additional credits, it far outweighs the potential cost savings of just buying cheap credits on the spot market.
Right.
This realization is driving a premium for verifiable long-term supply. And that's fundamentally changing how climate action is being valued and financed on corporate balance sheets. It marks a critical shift, I think, from viewing offsets as just a compliance or PR tool towards seeing them as genuine investments in climate impact and long-term business resilience.
That really drives home the message for developers then. Bringing those high-quality projects to market is absolutely critical in this environment where the demand is heading.
Couldn't agree more. If you're a developer demonstrating integrity, permanence, additionality, robust MRV, that's your ticket to attracting these long-term buyers.
So, talking about supporting this need, how does Aither Group step in? How do you support clients in this evolving voluntary carbon market, especially around project development and securing these deals?
That's an excellent and very relevant question. At Aither, we leverage over 15 years of leadership in environmental markets. Our core mission really is to simplify this often complex world of carbon offsetting.
Mm-hmm.
We aim to connect discerning buyers, those looking for that high quality we just discussed, with high-impact carbon offset projects. We want to ensure that the climate action being funded is both meaningful and robust. We recognize that finding high-quality credits can be daunting, so our role is essentially to bridge that gap effectively.
And specifically on the project development side.
Right. For project development specifically, our Aither Impact team acts as a dedicated advisor for clients looking to develop carbon projects. And we operate globally. We work in established developed markets, but also, very importantly, in crucial emerging markets across Africa, Latin America, and Southeast Asia, where so much potential lies.
Right.
We have a highly specialized team of experts, many of them engineers, which is quite important for the technical aspects. Everything from regenerating forests and mangroves, which is nature-based,
Right.
to helping develop cutting-edge carbon capture technologies or sustainable aviation fuel projects, which fall under technology-based solutions. It's a broad portfolio.
That's a wide range.
It is. And a core part of our approach, crucially, is focusing on ensuring these projects not only meet rigorous environmental ambitions, meaning they genuinely reduce or remove the carbon they claim to.
The integrity piece.
Exactly, the integrity piece, but also that they achieve high sustainable development goals coverage. The co-benefits, because buyers increasingly prioritize projects that deliver both that undisputed carbon integrity and these broader societal and environmental benefits.
Right. It's not just about the carbon anymore.
Not at all. So this comprehensive approach makes the projects we advise on exceptionally attractive for these multi-year offtake agreements.
But this brings us to a really crucial point then. What about the inherent risks? We always hear about risks in the carbon market. For companies making these long-term commitments via offtake agreements, what should they be fundamentally aware of when it comes to carbon credits themselves? Why are these risks so critical to understand before signing on the dotted line?
That raises an absolutely critical question. Addressing it honestly and transparently is really at the very heart of establishing trust and credibility in this entire market.
Right.
Because the whole voluntary carbon market, its value proposition, relies on a fundamental assumption that each carbon credit genuinely represents 1 metric ton of CO2, equivalent CO2e, that has been demonstrably removed, reduced, or avoided from the atmosphere.
1 ton, 1 credit.
That's the promise. This critical concept is called materiality. Does the credit materially represent the climate benefit it claims? If a project lacks materiality, meaning its claimed impact isn't real or it isn't lasting or it wouldn't have happened anyway, then it introduces major risk.
It's for the buyer.
Absolutely. Risk of reputational damage from greenwashing claims, risk that their climate targets aren't actually being met, risk that their investment is wasted. It fundamentally undermines a company's sustainability efforts if the credits aren't real.
So what are the core pillars of this risk?
Well, there are 3 fundamental pillars of carbon credit risk that buyers and developers too must deeply understand. They are permanence, additionality, and linkage.
Okay, let's break those down. What's permanence?
All right, permanence. This refers to how long the carbon will actually remain stored out of the atmosphere once it's been removed or its emissions have been avoided.
How long it sticks around.
Exactly. Now, the science, like from the IPCC, the Intergovernmental Panel on Climate Change, suggests the CO2 has an atmospheric lifetime of anywhere from 5 to 200 years. It's complex, but the market generally considers 100 years as the sort of benchmark threshold for permanence in carbon projects.
100 years is the goal.
That's generally the target. However, a significant challenge arises, particularly with nature-based solutions. Many forestry projects in the VCM, for example, only have an anticipated operational lifespan or crediting period of maybe 30 years.
So less than 100.
Potentially, yes. And this creates a potential gap in ensuring that long-term carbon storage, which introduces risk. Is the carbon truly locked away for the long haul?
Right. Are there examples of this being an issue?
Yes, unfortunately. For instance, a paper from Carbon Plan back in 2022 highlighted a critical issue in California's official forestry program, run by CARB, the California Air Resources Board. This is a major compliance market. Their program has a buffer pool of credits set aside, specifically designed to cover unexpected losses, like from fires, over a 100-year period.
Like insurance.
Sort of, yes. But the study found that this buffer pool was nearly one-fifth depleted in less than a decade, mostly due to major wildfires.
Wow, in less than 10 years.
Yes. It starkly illustrates the inherent risk of unforeseen circumstances, especially natural disasters amplified by climate change affecting the long-term storage and integrity of carbon, even in well-designed, regulated projects.
And presumably the risk is similar or higher in the voluntary market?
You could argue it's potentially higher, as VCM projects might have smaller buffer pools or less stringent long-term monitoring requirements compared to compliance markets like CARB. So permanence is about ensuring that a carbon credit isn't just a temporary fix, but represents lasting climate action.
Permanence is clear. What about the second one, additionality?
Right, additionality. This is an absolute cornerstone requirement. It means that the emissions reduction or removal achieved by the project would not have happened without the revenue generated specifically from selling the carbon credits.
It has to be additional to what would have happened anyway.
Precisely.
Yeah.
If the project or the specific climate-friendly activity would have occurred anyway, maybe because it was already legally required,
Yeah.
or it was already financially profitable without carbon credits, or the land was already protected,
Right.
then it fundamentally lacks additionality. In such cases, the carbon credits generated aren't creating new climate benefits. They're essentially just funding something that was happening regardless.
So the money isn't making the difference.
Exactly. The carbon finance isn't the deciding factor. There was a notable example of this reported by Bloomberg Green a few years back in 2020.
Yeah.
They investigated some projects run by the Nature Conservancy. These projects claimed carbon savings from protecting existing trees. But the reporting suggested these trees weren't actually endangered or at any real demonstrable risk of being cut down.
So no real threat meant no real additionality.
That was the criticism. And it led to significant negative attention for the corporate buyers involved, I think JP Morgan and Disney were mentioned, for investing in projects that allegedly didn't meet this basic additionality requirement. It's a crucial test for the integrity of any carbon credit. Did the carbon money make this happen?
Definitely a critical question. Okay, permanence, additionality. The third was leakage.
Yes, leakage. This is another potential pitfall. Leakage occurs when a carbon project implemented in one specific area inadvertently causes an increase in emissions somewhere else.
Shifting the problem, not solving it.
Exactly. It just shifts the emissions activity. The classic example is a forest protection project. Let's say it successfully prevents logging within its designated boundary, which sounds great, but if that logging activity simply moves to an unprotected forest right next door to meet the same ongoing demand for timber, then that's leakage. The emissions saved in one place are canceled out by emissions created just outside the project boundary.
Undermining the whole benefit.
Completely undermines the project's net climate benefit. There was a study, I believe by researchers at UC Irvine around late 2022 that found evidence suggesting this might be happening in some California offset projects.
Oh, really? Even in the compliance market?
The study suggested it. They noted that some projects focused on protecting, say, lower-value tree species on a piece of land, while logging perhaps continued or even increased on other unprotected parts of the same landowner's property. It demonstrates how a project's apparent benefits in one specific area can be potentially undermined by these unintended consequences elsewhere. It really highlights the importance of taking a holistic view, looking beyond the project's fence line when evaluating its true impact. It's a common challenge, especially for these area-based projects like forestry or agriculture.
Permanence, additionality, leakage. Those examples really underscore the complexities involved. It's not simple.
Not at all.
So given these significant risks, if a company is looking to make these long-term commitments through offtake agreements, how can they realistically evaluate a project's materiality? How can they proactively manage these risks effectively? What are the key tools and best practices they should be using to navigate this intricate landscape? It sounds like due diligence is critical.
Due diligence is absolutely essential. It's non-negotiable for buyers wanting to protect their investments, their climate claims, and ultimately their reputations. There are Broadly speaking, three core ways that companies can comprehensively assess and manage these risks.
Okay, three core ways. What's the first?
The first is undertaking a rigorous evaluation of the project design and its methodology. This means getting into the details. Buyers should meticulously review the publicly available project design documents, or PDDs, which are available from the major carbon registries like Verra or Gold Standard.
So read the project documents carefully.
Very carefully. And you need to scrutinize several key areas within those documents. First, look at the baseline assumptions.
The business as usual scenario.
Exactly. Ask yourself,
Yeah.
is the scenario describing what would have happened without the project truly realistic? Does independent data, perhaps from the local region but outside the project boundary, actually support this baseline claim? Is the deforestation rate claimed realistic for that area?
Okay, check the baseline. What next?
Review the project methodology itself. That's the specific set of rules and calculations used to determine how many credits are issued. Some older methodologies, as we discussed, have faced scrutiny for using outdated techniques or assumptions that might have led to overissuance of credits. Buyers should always check if the methodology is current, if there have been recent updates, and if the project developer has deviated from the standard methodology in any way, and why.
Methodology check. Then?
Look at the buffer pool size. Remember the insurance concept?
Right, the credits held back for unexpected losses.
Yes. This is typically a percentage of credits held by the project developer as a safeguard against potential losses from fires, disease, or even reversals if additionality is later questioned. Many projects hold around, say, 10% of their annual issuance in this buffer. But buyers need to weigh this percentage against their assessment of the project's overall risk profile, especially the baseline accuracy. Why? Because significant overissuance due to a faulty baseline is often the most likely reason why losses might exceed what the buffer pool can cover. A bigger buffer isn't always better if the fundamental calculations are flawed.
Good point. What else in the documents?
Then we look for co-benefits. Many high-quality projects are designed with associated UN Sustainable Development Goals, SDGs. Things like biodiversity improvements, creating local jobs, improving water access, empowering women. These benefits often don't disappear even if the exact CO2 impact is later questioned or adjusted downwards. Quantifying these co-benefits can highlight the project's independent value proposition beyond just the carbon math.
So value beyond carbon. Important.
Yeah, very important. And closely related is community engagement, especially for nature-based offsets. Robust, genuine engagement with local communities and solid plans for local hiring are crucial. For ongoing monitoring, for maintenance, for ensuring the project's longevity and local acceptance. A lack of genuine community buy-in can also sometimes contribute to linkage risk if local people feel excluded from the benefits.
Makes sense. Local support matters.
Absolutely. And finally, circle back to additionality verification. Really confirm that the project would not be economically viable without the income from carbon credit sales. Review the cost estimates provided, look at the registry's own additionality assessment tools and methodology, and crucially, ensure there wasn't any planned regulatory action that would have forced the project to happen anyway, regardless of carbon finance.
Right, the regulatory check.
Yes. And for forestry projects specifically, verify, is the project on existing forest land that faces a credible, ongoing deforestation risk? Or, if it's reforestation, is it happening on genuinely new land, providing stronger, clearer benefits than just protecting something that might not have been cut anyway? These detailed checks are vital.
Okay, so that's the first way.
Yeah.
Deep dive into the project documents. What's the second approach?
The second approach, if a buyer has the capability either in-house technical expertise or through consultants, is to leverage the independent collection of verification data using geospatial data.
Geospatial data, you mean like satellite imagery?
Exactly. Publicly available satellite data offers incredibly powerful objective insights, especially for nature-based projects like forestry or agriculture. And often, this data is available at low or even no cost.
Interesting. How does that work?
Well, imagine being able to independently verify deforestation rates within and around a project area using satellite images taken over time. Or monitor the health and density of vegetation using specific indices derived from satellite sensors. Or even assess wildfire risk by looking at moisture levels in the landscape.
So you can check their claims from space.
Essentially, yes. Tools leveraging data from sources like the European Space Agency's Sentinel satellites or the publicly available Planet NICFI data funded by Norway. These provide high-resolution images and specific data products.
Like what kind of data products?
Things like NDVI, the Normalized Difference Vegetation Index, which measures vegetation health. You can see if a reforestation project is actually resulting in healthy growth. or NDMI, the Normalized Difference Moisture Index, which helps determine vegetation water content and drought stress, indicating wildfire risk, which relates back to permanence. There are also specific satellite instruments designed to detect land surface temperature, useful for monitoring fire events. And other indices like TGI or VARI can help assess vegetation greenness even in cloudy tropical regions.
Wow, that's quite technical.
It can be, yes, but by analyzing these data points, buyers can get an independent understanding of project permanence, like its vulnerability to wildfires. They can also help vet additionality and leakage claims by comparing vegetation growth or land use change before the project started versus during the credit issuance period. It allows buyers to build their own objective risk matrix, complementing the project documents.
So it's like a second opinion from satellites.
A very powerful second opinion, yes.
Yeah.
It adds a crucial layer of independent due diligence that goes beyond just reviewing what the project developer provides.
Okay, document review, satellite data. What's the third core way to assess risk?
The third option, especially valuable for those buyers who don't have deep internal technical expertise or the resources for extensive geospatial analysis, is to utilize third-party ratings data.
The rating agencies.
Exactly. And while some buyers, it's fair to say, remain a bit skeptical of rating agencies, perhaps questioning their methodologies or consistency, their utility is definitely growing.
How so?
They provide a relatively quick way to compare different projects on a somewhat standardized basis. They offer a valuable snapshot, even if they shouldn't be the only source of due diligence.
Okay, that makes sense. So after a buyer has gone through all this, reviewed the documents, maybe looked at satellite data, consulted ratings, how do they then translate all that risk assessment into their actual willingness to pay for a credit, especially when they're considering a long-term offtake agreement? It feels like the price isn't just about the number on the sticker anymore, but all these complex underlying factors.
That's the crucial next step, absolutely. It's where the rubber meets the road, translating risk into value and price, and it requires a structured approach. If, after your due diligence, you conclude that a project fundamentally lacks additionality, meaning the climate benefit would have happened anyway,
Right.
or if it exhibits significant unmitigated leakage, where the benefit is effectively canceled out elsewhere, then, from a purely carbon offsetting perspective, the base willingness to pay, WTP, for that carbon component should, in a strict sense, probably sit at $0.
Even if the project is doing some good.
For the carbon offset value, yes. This isn't to say the project is useless entirely. It might still have significant inherent value from its co-benefits. Maybe it protects critical biodiversity or provides clean water or supports local livelihoods. Those aspects are incredibly important, and a company might still choose to fund the project for those reasons as part of their broader corporate social responsibility or sustainability initiatives. But the credits shouldn't really be purchased or claimed for the specific purpose of emissions offsetting if they fail fundamentally on additionality or leakage. It becomes more of a philanthropic or impact investment rather than a carbon offset in the strictest sense.
Okay, that's a critical distinction. So, assuming a project passes the additionality and leakage tests, what happens next with price?
Right. Once those two binary criteria, additionality and leakage, are firmly met, then permanence acts more like a continuous indicator, influencing the WTP.
How does that work?
As we discussed, the market generally uses 100 years as the benchmark for acceptable permanence. So buyers should then review the project's contracted duration for monitoring, reporting, and verification, MRV. They need to look at the long-term maintenance plans, the staffing levels committed to ensure the project endures. They should also assess data on the specific risks of carbon loss in that region due to climatic conditions like droughts, fires, or disease outbreaks.
So, assessing the likelihood of it lasting 100 years.
Exactly. Does the project, considering all these factors, provide a reasonable guarantee of sequestration for 100 years, or ideally even longer? Projects that can confidently demonstrate and contractually guarantee sequestration well beyond this 100-year threshold, perhaps using very stable storage methods like geologic sequestration. Well, they may well command a higher price. They offer stronger materiality guarantees.
Right. And what about projects that only guarantee, say, 30 years?
That's where the buffer pool becomes critical again. Even projects with a shorter operational time horizon, like 30 years, might still argue they offer a 100-year benefit if their buffer pool is sufficiently large and robustly calculated to cover potential losses from deforestation, fires, or disease over that longer 100-year time frame.
The buffer bridges the gap.
Potentially. But a thorough review of regional climate data and risk factors is absolutely essential to determine if the buffer pool size is actually adequate for the specific risks that project faces over 100 years. buyers need to decide on an acceptable risk threshold regarding the buffer's adequacy.
So you establish the base carbon value based on additionality, leakage, and permanence. Then what?
Then once that base carbon value is determined, buyers typically assess the premium they're willing to pay for the project's associated co-benefits.
Adding value for the SDGs.
Exactly. This allows them to quantify not just the climate impact, but also the broader positive social and environmental outcomes of their investment. How much extra are they willing to pay because this project also protects endangered species, or provides X number of jobs, or improves health outcomes? This is increasingly important for stakeholder engagement, for brand reputation, and for telling a compelling story about the investment. So the final price reflects both the core carbon integrity and the value of those additional benefits.
That provides a really clear framework for thinking about value and price beyond just the headline number. But it certainly sounds like a lot of responsibility rests on the shoulders of the buyers in this evolving market. It's complex.
It is complex, yes.
So what are the best practices for strategically mitigating these risks, both operationally within the company and contractually within the agreements, once a company decides, okay, we want to proceed with this offtake agreement? It's not just about finding good projects initially, but protecting that long-term investment.
You're absolutely right. Proactive risk measurement, clear communication of that risk internally and externally, and robust mitigation strategies are crucial. It's an ongoing process. Companies can implement several key practices here.
What are some operational strategies?
All right, for operational risk mitigation, one highly effective strategy, and probably the most common, is to diversify your portfolio of carbon credits. Don't put all your eggs in one basket.
Makes sense. Like investing.
Exactly like investing. Consider a mix of project types. For example, as we mentioned, technology-based projects like direct air capture or carbon capture and storage, CCS, generally offer inherently stronger permanence guarantees that provides a very high degree of permanence confidence. This contrasts with nature-based solutions, which, while offering vital co-benefits, do carry higher risks from natural disturbances or human activity. So a well-diversified portfolio might include a solid core of robust nature-based projects with strong co-benefits, alongside some technology-based removals for permanence, and perhaps a smaller allocation to high-quality, rigorously verified avoidance or reduction projects.
Okay, diversification is key. What else operationally?
Critically, always work with reputable developers. Partnering with experienced project developers who have the financial stability, the technical expertise, and a proven track record of actually delivering on their contractual obligations is absolutely key. Due diligence on the developer themselves is just as important as due diligence on the project. Can they actually manage the project long-term?
Good point. Developer track record matters. Okay, those are operational. What about methodology risk? You mentioned methodologies get updated.
Yes, methodology risk mitigation is another angle. Registries typically update their methodologies every 3 to 5 years to incorporate new science, better data, improved best practices. This is good. It improves integrity over time.
But it creates a risk for older projects.
It can, yes. It can create a gap where an older project, validated under an older methodology, might not fully align with the latest scientific understanding or data. This could lead to questions about the true volume of carbon credits it should be issuing today.
So how do buyers mitigate that?
One way is to design offset programs focused on novel technologies. Some pioneering organizations are choosing to invest directly in new carbon capture methods or innovative project types that don't even have established methodologies yet.
Really? Why do that?
They're focusing on the future value, on helping to bring these critical next-generation solutions to market scale. It's a higher risk, higher reward strategy focused on innovation rather than just buying existing credits.
Interesting. Okay, what about public perception risk? That seems huge in the voluntary market.
Absolutely huge. Public perception risk mitigation is vital, maybe even paramount, precisely because this is a voluntary market. Negative public scrutiny, accusations of greenwashing, they can have significant financial and reputational consequences for buyers.
Especially for certain project types.
Particularly for nature-based credits, yes. While renewable energy credits and nature-based credits have somewhat similar volumes traded in the VCM, nature-based credits account for, by some estimates, nearly 80% of the market's value.
80%? Why so much?
Largely due to their powerful marketing and storytelling potential. Images of forests, wildlife, community benefits, they resonate strongly with consumers and stakeholders, and that works extremely well. Until a problem arises with the carbon accounting or the project's integrity. Then the backlash can be equally strong.
So how do companies address this proactively?
One key way is to rigorously quantify and highlight the co-benefits. Work closely with the project sellers to clearly measure and articulate the tangible, positive impacts beyond carbon. For example, track the number of local staff hired, calculate the direct economic benefit flowing into the community, document the number of households with better access to clean water or energy, measure biodiversity gains.
Make the other benefits clear and measurable.
Exactly. By doing this, these co-benefits provide independent, verifiable value. They create positive impact that can stand on its own, even if the specific CO2 impact is later questioned or debated by critics. It allows companies to tell a broader, more resilient, and more easily defended story about their investment's positive contributions.
That makes a lot of sense. Diversify the value story.
Precisely. And finally, we must consider political and geographical risk.
Country-level risks.
Yes. Policy changes within the host country of a carbon project can significantly impact its viability or the usability of its credits. We saw examples in 2022. Indonesia, for instance, temporarily halted the issuance of certain types of forestry credits, VCS REDD+. Honduras declared a moratorium on forest carbon credits that weren't recognized under the UN climate framework.
So governments can just change the rules.
They can, and they do. Buyers must be acutely aware of the specific policies and political climate in the countries where their projects are located. They also need to track the ongoing international debate around corresponding adjustments. That's about how carbon credits are accounted for under the Paris Agreement. Essentially, it's about avoiding double counting, ensuring that a ton of CO2 reduced isn't counted towards both the host country's national climate target and the buyer's voluntary offset claim. The rule applies to the voluntary market are still evolving and differ by country.
So uncertainty there, too.
Significant uncertainty. So mitigation here involves staying constantly informed about regulatory shifts at both national and international levels, and again, diversifying investments geographically to spread this political risk. Don't concentrate all your projects in one country or region.
Okay, that's a truly comprehensive framework for thinking about and mitigating these diverse risks. It's clear that navigating this requires real expertise. With all these factors in mind, then, how does Aither Group uniquely position itself to help clients navigate this complex landscape, both in terms of supporting project development and then facilitating these crucial long-term sales structures like offtakes?
Right. Well, Aither Group operates right at the heart of the global voluntary carbon market. Our expertise, which is built on over 15 years of direct leadership and experience in environmental markets, is specifically designed to simplify this complex world for our clients, whether they are developers or buyers. We understand the nuances deeply. We specialize particularly in strategic offset sourcing and offtake arrangements, precisely the topic we've been exploring today. We actively enable our clients to hedge against that price volatility we discussed, and critically, to secure their long-term supply of high-integrity credits. We do it through both carefully selected spot market transactions, when appropriate, but increasingly through structuring these vital multi-year forward offtake agreements. Our dedicated carbon trading desk provides clients with direct access to a truly global portfolio of high-integrity offsets. And these aren't just random credits. They are carefully gated and tailored to meet the specific budget, volume, co-benefit preferences, and overall impact requirements that you, as a client, might have.
Tailored access to quality supply.
Exactly. It ensures a consistent, reliable flow of quality credits that genuinely align with your strategic sustainability goals, rather than leaving you exposed to the uncertainties and potential quality issues of simply buying whatever is available on the spot market at the last minute. Well, beyond just sourcing transactions, we offer comprehensive portfolio management and advisory services. Our expert team works very closely with clients to develop truly tailored carbon offset portfolios. This involves ensuring not just quality, but also a balanced mix of project types, maybe combining nature-based solutions with some technology-driven removals, ensuring geographic diversity to mitigate those political risks we talked about. And importantly, selecting projects with the co-benefits that resonate most strongly with your organization's values and your key stakeholder expectations. It's about building a portfolio that tells a coherent and compelling story.
Right, a strategic portfolio, not just a collection of credits.
Precisely. We also extend our expertise to sourcing for compliance obligations. We help clients navigate the complex intersection where voluntary offsets might be used or interact with various compliance schemes. A key example is carbon offsetting and reduction scheme for international aviation, a global compliance system. We help airlines and others source eligible credits for that scheme.
And what about the due diligence aspect? You emphasize that heavily.
Absolutely critical. Integrity is paramount for us and for our clients' reputations. We conduct rigorous due diligence and transaction support on every single project that enters our portfolio or that we recommend to a client. We use a combination of document review, data analysis, sometimes leveraging geospatial tools, and assessing against frameworks like the ICVCM principles. Thorough vetting is standard practice. And then we provide end-to-end transaction support. This covers everything from the initial price negotiation and structuring the legal agreements, ensuring those protected clauses are included, right through to ensuring the secure retirement of the credits on the appropriate registry and providing comprehensive reporting that will stand up to internal audits and external scrutiny.
End-to-end support.
Exactly.
What an insightful exploration, really revealing the complexities, but also, I think, the immense opportunities in securing carbon credit supply through these evolving mechanisms like offtakes.
It's certainly a dynamic space.
We've covered so much ground, from the fundamental definitions of offtake and forward agreements to those critical risks everyone needs to understand: permanence, additionality, leakage, and crucially, how diligent evaluation using multiple tools are absolutely key to mitigating those risks effectively.
Indeed. And leveraging expert partners like Aither, who can guide them confidently through this complex terrain.
Ultimately, then, whether you are on the side developing a project or you're on the side looking to secure your supply for climate commitments, the core message seems clear. Strategic, long-term thinking, backed by that thorough, ongoing due diligence. It's not just beneficial anymore, it seems absolutely essential for achieving meaningful climate action in today's market.
I completely agree. It's essential for credibility and for real impact. The voluntary carbon market is evolving incredibly rapidly. That's undeniable.
Thank you so much for joining us on Aither Insights today. We sincerely hope this exploration has equipped you with valuable knowledge and practical insights to better navigate the dynamic world of environmental commodities.
It was a pleasure. Until next time, stay informed, stay curious, and keep driving that positive impact.